So let's talk about college savings. If you are saving or want to save for your kids' college, you should consider a 529 plan. It's actually one of the best ways to put money aside for education. Here's how. A 529 plan is basically a special kind of savings account that's made just for education. You could open one up and start putting money into it whenever you want. That money can grow over time, kind of like a retirement account. But instead of being for your golden years, it's for things like tuition, textbooks, room and board, and other school expenses. And for the big bonus, you don't have to pay taxes on the money as it grows. And if you use it for qualified education expenses, you don't have to pay taxes when you take it out either. That's a pretty sweet deal. Another great thing about a 529 is that you, the parent or grandparent or whoever opens the account, are the one who controls it. The money doesn't automatically go to the kids when they turn 18. You stay in charge. So if your child decides not to go to college right away, or ever, you can usually switch the beneficiary to another family member, like a sibling, or even yourself if you decide to go back to school. Some states even give you a tax break when you contribute to your 529 plan. Not all of them, but it's worth checking into to see what your state offers. You're not stuck with your state's plan either. You can shop around and use another state's plan if it has better investment options or lower fees. Just keep in mind, your own state's tax rules still apply no matter which plan you choose. So, if your state gives you a tax deduction or credit for contributing to the plan, you usually only get the break if you stick with your state's version. If you use an out-of-state plan, you'll still get the federal tax benefits, but you might miss out on the local tax perks. That's something to weigh when you're comparing options. 529 plans are created by Congress back in 1996 to encourage families to save for future college costs. They're named after Section 529 of the IRS tax code, which is where all of the rules live. Before that, there weren't many tax-friendly ways for regular people to save, especially for education. The idea was to give parents a better shot at keeping up with rising college prices and to help students avoid drowning in loans later. Over time, the plans have expanded, and now they can even be used for things like K-12 tuition, apprenticeships, and sometimes student loan payments, depending on the rules in your state. Now, if you're wondering how to actually find all this information or how to pick a plan without going down a research rabbit hole, you're not alone. One of the easiest places to start is a website called savingforcollege.com. It's super user-friendly, and you can compare different state plans side by side, see which ones are rated the highest, and find out if your own state offers a tax benefit. Another good source is Morningstar.com. They publish rankings every year of the best 529 plans based on things like performance and fees. Just search for Morningstar 529 plan rankings and you'll find their latest list. If you want official info straight from the source, most states have their own 529 website. You could just Google something like Ohio 529 plan or Texas 529 plan, and it will take you right there. There's also a helpful nonprofit site at thecollegesavings.org that links out to every official plan and gives a nice overview of your options. Between these, you'll get everything you need without having to guess or dig too deep. Opening a 529 plan is actually really simple, and you don't need a financial advisor to do it. You just go online, pick a state's plan, either your own or another one with better options, then click to open an account. You'll fill in some basic information about yourself and your child, who's called the beneficiary. After that, you choose how you want to invest the money. Most people go with an age-based portfolio that gets more conservative as the child gets older, but you can customize it if you want. Then you link your bank account and make your first contribution. Some plans let you start with as little as $25. You can add money whenever you want or set up automatic monthly deposits. Once it's set up, you can manage everything online. You can even let grandparents or friends contribute if they want to help. Here's a tip. Some employers offer a way to automatically send part of your paycheck directly into a 529 plan through something called payroll deductions. That means the money is taken out before you ever see it, which makes saving easier and automatic. Not every employer offers this, so it's worth asking your HR department or benefits coordinator if they have a 529 plan payroll deduction option. If they do, they can help you get started. If not, no worries, you can always set up and fund your 529 plan on your own. Now you might be wondering, don't I get to pick what it's invested in? Yes, but not like picking individual stocks. Each 529 plan gives you a selection of ready-made investment groups. These groups pull money together to buy lots of different stocks and bonds, so your money isn't all tied up in just one company. You pick from options that range from more aggressive, trying to grow more, but with more risk, to more conservative, less risk, but usually grows slower. One popular choice is an age-based option that automatically adjusts to be more conservative as your child gets closer to college age. When people talk about a plan's performance, they mean how well these investment groups have done over time, how much they've earned after fees. So picking a plan with a good investment options can make a big difference in how much your savings grow. Also, the money you put into a 529 plan goes in after tax. That means you're contributing money you've already paid income tax on, but the money grows tax-free while it's in the account. And when you take it out for qualified education expenses, you don't pay taxes on those withdrawals either. Some states may offer a tax deduction or credit when you contribute, so it's worth checking your state's rules. What if you take money out and don't spend it on education? That can happen. The IRS expects you to report that withdrawal when you file your taxes because the 529 plan will send you a tax form showing how much you took out and how much of it was earnings. You'll owe income tax on the earnings part, plus usually a 10% penalty. The IRS doesn't have a direct way to check how you spend the money, but since the plan reports the withdrawal, it's up to you to use the funds properly or pay the tax and penalty. To avoid that, you can also change the beneficiary to another family member who might use the money or just leave it in a plan to grow for a future student. So, saving for college can feel overwhelming, but 529 plans are designed to make it easier. They're a great way to give your kid a head start and maybe yourself a little peace of mind. That's it for now. Thanks for watching. Please like and subscribe. We'll see you next time.